Welcome back, you legends. I'm Dr. Khan. Let's get right into this quick update video ahead of the CPI tomorrow. So the Dow is up 0.8% today, the NASDAQ 1.76%, and the S&P 1.28%. Let's take a look at the different sectors. Leading today was real estate, followed by consumer cyclicals, communication services, and technology. So today was a full-on risk-on day with tech, cyclicals, and communications, leading with healthcare, defensives, and utilities lagging. That's what you would like to see in a risk-on move in the market, where market participants are taking on more risk betting on the stock market. Let's take a look at the stock market map. Real estate up massively today. Cyclicals, Amazon, Tesla, Home Depot, Lowe's, all up. Google up in the communication services sector. Tech led by Apple and Microsoft today. Let's take a look at the daily chart for the S&P 500. Today, we are deep in my resistance level, which maxes out at $395 right over here. So we basically, guys, hit most of the upside in this move to the upside since that bottom on January 5th. We are now just, let's see, $3 away, $2.50 away from the 200 daily moving average, as well as the weekly expected move over up top is also a significant descending resistance line, which acted as a major level of resistance throughout this bear market. So from a risk reward point of view, guys, the risk is skewed to the downside significantly from this point on, which is surprising because I'm actually on the side that CPI is going to come significantly down versus last month. Let's take a look at CPI tomorrow, guys. It's going to come out at 8:30 a.m. So an hour before the market open. We have the year-on-year inflation rate, CPI headline, as well as the core inflation rate, with the consensus coming in at 6.5% for the headline figure and 5.7% for core inflation. Now, we know for a fact that inflation has come down in December. However, the question is, has it come down enough to meet the consensus, or is it going to miss to the upside or miss to the downside? We don't know yet, but we do know that the CRB index, the commodities index, has come down significantly in December. Let's take a look at this. This was the month of November, and this is the month of December, and it has come down significantly, 1%, nearly 1% in the commodities index, and even more this month, an additional 2% to the downside in commodities. So we know for a fact inflation is coming down. It has come down in December. It's going to come down again in January. We know that for a fact based on the CRB index. And if you actually plot inflation over this index, you will notice that there's a very strong correlation between the two. Here it is, guys. I've added it to the chart. The orange line is inflation year on year. And look at this. It topped exactly as the CRB index predicted. And it continued to go down, following the CRB index almost exactly to the T. So we know inflation is going to come down this month, and it has already come down in December. We know that already. The question remains, is it going to meet expectations or miss to the upside or to the downside? We have no idea. What we do know for sure from the technicals is that this move to the upside is very significant, meaning that the risk has skewed significantly to the downside. We have basically met our price targets already ahead of the CPI. In addition to that, guys, we absolutely hate seeing the market rally ahead of CPI because it's just a very bad omen. Take a look at this massive rally ahead of CPI, and look at this massive rally ahead of CPI, and what ended up happening, a massive crash on the CPI release. Another example is this, guys. We had a massive rally ahead of CPI. Then we had that massive dump post CPI. So we do not like to see a rally ahead of the CPI. So if you guys remember from my weekly update video, I talked about me anticipating that the market will do something like this, right? Rallies, comes back down to test this support line ahead of CPI, and then rally into CPI. The alternative was the opposite, where the market rallies ahead of CPI and then comes crashing down post CPI. We have to see the market come down. It has not come down ahead of CPI, so the logical conclusion is that it will come down post CPI. Simply because the market is way too optimistic ahead of CPI. A lot of the inflation cooling off effect has already been priced in this massive move to the upside. In fact, guys, if we take a look at this move to the upside ahead of CPI back in September, the market rallied by 5.5%. If we take a look at this rally, the market rallied by just under 5.5%. So we could expect, let's say, a gap up tomorrow on a cooler than expected CPI number. So something that looks like this, a gap up in the pre-market where we could rally all the way up to 400 in the pre-market session, open at 398 where the market sells off slightly before the market open. We open at 398 and then we dump. Right, a lot of profit taking, etc., etc. Simply because, look at this. This is the upper weekly expected move. We have the 200 daily moving average, the descending resistance line. A lot of messy resistance up top here. It makes absolutely no sense to go long at this level. I am still net short. I only opened one small hedge position in case the market does gap up tomorrow to protect my shorts. That's it. Just one hedge position. I am still net short by a long shot. Now, not only has the S&P already hit our resistance level, the NASDAQ is pretty close to hitting our resistance level at 280 bucks, where the 100 daily moving average is descending as well as this resistance line. So again, expect something that looks like this. The market gaps up in the pre-market, then we open high, let's say at 280, and then we dump, okay? That's my expectation. Another possibility is that we simply put in a massive indecision doji at the top. Usually that signals a reversal. So at this point, guys, I do not see a lot of upside left. Some upside left, but not a lot. If you go picking stocks, then you could see some upside left perhaps. Something like Tesla, for example, guys, I do see some upside left. That's why I actually took my hedge position in Tesla to protect myself against the upside risk on CPI. That's why I picked Tesla to go long in a very short term call option, just in case we gap up tomorrow. So guys, my expectation is we gap up tomorrow and sell off. Alternatively, we simply just immediately sell off without a gap up. I don't see really a lot of upside left. So we could see either an indecision candle, right, a gap up and then a massive sell-off, or simply we immediately start selling off. One of those three, I do not see, for example, a gap up and a run, something that looks like this. If that does end up happening, that will be a game changer. That will be absolutely a game changer because it will take out this resistance line for the first time. That will mark the beginning of a new significant uptrend in the market. So there is a small chance that does end up happening. If that does end up happening, I will be closing all of my short positions and I will be switching to buying the dips in case that happens. But right now, I do not see that happening. Very tiny chance of that happening. In fact, if we take a look at the VIX, guys, the volatility index, look at this low, higher low, another higher low. Even though the market has been rallying, we've been putting in higher lows on the VIX. In addition to that, we're getting super close to crossing down on the VIX. And usually when we get super close to a cross down, the market tends to see massive volatility and a massive sell-off in the S&P. In fact, let me add the S&P on here. Take a look at this, guys. We came in very close to crossing down on the VIX here, December 23rd. And then we ended up with this massive spike in volatility and a dump. We're now again very close to seeing that crossover, and we'll likely see something that looks like this in the S&P, gap up, and then we move down. And so the VIX moves up and then stays up or even moves higher as it continues to form this symmetrical triangle, which will end up breaking to either side. I am leaning more towards the upside on volatility and the downside on the S&P by the end of the month. Generally speaking, guys, we do not like to go long at a VIX of 21. It just hasn't been a good entry level. You want to be long when the VIX is super high, right? When volatility is super high, that's when the S&P is cheap, relatively speaking. When the VIX is this low, you actually want to be shorting the market. When the S&P is getting super close to the 200-day moving average, when it's getting super close to this resistance line, it's when you want to be short, not long. Now, interestingly, guys, let's go back to the CRB index, the commodities index. Commodities have actually been trying to bottom. If you notice, guys, we've actually put in a lower low on the daily chart and a slightly higher low on the PPO. And so commodities may be bottoming here for the medium term. And we may be entering a vicious cycle, right? Where inflation moves down, then comes back up, moves down, comes back up. And the Fed turns from hawkish to dovish to hawkish to dovish, and then we just see this vicious cycle continue. The dollar weakens when the market is bullish, and the Fed talks about a pivot or a pause, etc. Then the CRB index spikes, the dollar index collapses, and then the Fed comes to the rescue, raising rates, crushing commodities, and rescuing the dollar, leading to even more downside in the market. So unfortunately, it's a vicious cycle that may begin to rain on this rally very, very soon. Let's take a look at another chart. This is the triple Qs divided by the S&P. This is a risk on, risk off barometer. We do have a double bottom on here on the daily chart with a positive divergence. This is a bullish setup, generally speaking. However, just be aware that 71 is going to be a massive resistance level. So even though we do have a double bottom on here, I do see a lot of risk to the downside. We could see again a gap up tomorrow with where the NASDAQ significantly outperforming the S&P by 1%. In fact, if it does open 1% higher than the S&P, let's say the NASDAQ opens 2% up and the S&P opens 1% up, we will be exactly at this resistance level. Then again, if the S&P opens up at 398 or very close to 400, we will have already filled this gap and tagged the 200 daily moving average, and that would be a really nice shorting opportunity to go to the downside, to short to the downside, especially with the options market pricing in an $8 move just for tomorrow. So even if the market rallies significantly at the open tomorrow, we get all of that implied volatility out of the options chain. Options become significantly cheaper, especially put options. Put options become significantly cheaper after the CPI report comes out. And that would, in my estimation, make for a very, very good short entry as long as we hold below the 200-day and do not take out this resistance line. Let's take a look at the smart money. Smart money continues to rip to the upside, but we're getting very close to this significant resistance level. So I do expect smart money to begin showing signs of a reversal at this point, probably starting after the CPI tomorrow. The 10-year yield is again sitting at a level of support. We could see something that looks like this tomorrow, right? A massive shoot to the downside and then a move back up, forming a rejection doji and beginning to move back up, right? So again, a gap up, move to the downside, and then with the 10-year yield, a gap down and a move to the upside. That's kind of what I'm leading to right now. It's the only scenario that makes sense at this point. The market is just way too optimistic ahead of CPI, and that's always been a really bad sign. Let's take a look at the dollar. The dollar continues to consolidate at this low. We do still have a big old air pocket here that goes all the way down to around 101.4. So this level, again, we could see the dollar gap down and then move to the upside as the market sells off. Now, throughout 2022, guys, what we've seen with CPI is that when you see a gap down, it usually indicates that the market will continue to move to the downside. When you see a gap up, it usually indicates that the market will continue to move to the upside. This was absolutely true up until December 13th, when the opposite happened, where the market gapped up and then it moved to the downside. It makes a lot of sense because this was a major level of resistance and the market was just way too euphoric and the PPO was already pointing to the downside. Let's take a look at gold. Gold has already hit my level of resistance of 175. This is a massive move to the upside. It will need time to digest. I think gold will probably top perhaps tomorrow on CPI, and that will be that. I'm still looking for a retracement all the way down to 160. That will be my future entry. Let's take a look at TLT. Again, TLT continues to rally. It's beginning to stall here at this level, which is a significant level of resistance at 106.55. So we could see again the TLT gap up and then move to the downside as the 10-year yield gaps down and moves to the upside. XLY divided by XLP, another risk on risk off barometer. We have hit a major level of resistance here, guys. It was a prior level of support. Once we broke through it, it will now act as a major level of resistance, especially with a descending 50-day moving average, again indicating that risk is significantly skewed to the downside all over the market. SMH, the semiconductor index, this is the SMH divided by the triple Qs. We have pretty much hit the all-time highs. Very, very bad place to go long on the NASDAQ or the semiconductors at this level. It has always been a very bad level to go long. If you take a look at this, guys, look at this. The last time we've hit this level, the market dumped massively. Look at this, market dumped massively. And we are now at this level again, expecting a massive dump. SMH, again, into my level of resistance, 220. We are edging slightly higher, so we could see something that looks like this tomorrow, right? And open at 225, similar to these prior opens, and then a gap down. Excuse me, a gap up and then a sell off. Let's take a look at NVIDIA. Again, entering my level of resistance. Pretty much every stock that I'm tracking is entering my level of resistance except for Tesla, which is why I only pick Tesla as my only hedge. Again, NVIDIA, a descending 200-day moving average. We could see a gap up similar to these gaps at 170 and then a sell off. Apple is coming pretty close into my level of resistance at 135. I will in fact be looking at Apple to open short positions, additional short positions, because I do believe that Apple is in the really last innings of this very complex Wyckoff distribution topping pattern, and I expect a massive dump in Apple that takes us all the way down to $80 by Q3 of this year. Let's take a look at breadth. This is the 50. This is the percent of S&P 500 stocks trading above the 50-day moving average. We are now at 74.6. Which again has been a major level of resistance where prior rallies have failed. Look at this failure here. Look at this, another failure, and now I'm expecting another failure post CPI. Let's take a look at the New York Stock Exchange Composite. This is the summation index. Below it is the oscillator. Summation index indicates that we are in an uptrend, but keep in mind, look at this New York Stock Exchange at prior significant levels of resistance. So I do expect to see selling here to take profit at least, if not a major sell-off that takes out this low. Let's take a look at the CPC put to call ratio. We do have a buy signal as of yesterday. The buy signal is triggered when the CPC 5-day moving average crosses below the 1.1 level, and then we get a cross down on the PPO. So we have a buy signal in the CPC, but keep in mind, unfortunately, this buy signal lost its reliability back in November and December of last year. So I added another chart to confirm, to corroborate these buy and sell signals, and it's the PC. Unfortunately, the PC did not corroborate the buy signal, right? Because we did not get a cross down on the PPO. We need to see the PC cross down, the PPO cross down on the PC as the CPC also crosses down. So we need both signals to corroborate each other. So far, the CPC has put in a buy signal without the PC putting in a buy signal. Actually, if we take a look at the buy signals in the last couple of months, they've actually come and then we saw a dump and then a rally, a dump and then a rally. So expect a dump and then perhaps one final rally, putting in something that looks perhaps something that looks like this, right? A gap up, sell off, we go back to the support line, we try to rally again, form a lower high or a similar high, and we form a double top, we go down, confirming this head and shoulders pattern, and then we sell off into early February. At least that's my expectation at this point in time. Let's take a look at the fear and greed index. We are edging towards greed. Unfortunately, greed is where bad things happen in a bear market, right? As we've entered greed levels in the past, these have been market tops, each one of them. Let's take a look at market momentum. We have crossed again up above the 125-day moving average, which was something that I was expecting. But now I do suspect that we will see a slow rollover and a sell-off after CPI. Stock price strength is continuing to move up, but we will likely form a double top. That's what I'm expecting at this point in time. Price breadth, I do expect us to make a lower high and then sell off from there. Put to call ratio, this head and shoulders top did confirm a bottom here, and we are now, and we have already rallied from that bottom, and so we are at the end stage of this short-term counter trend rally. That's my assessment. I was hoping for something that looks like this, a bounce back at 380, something that looks like this, right? A sell-off ahead of CPI and then a rally after CPI. That would have been way more bullish. Fortunately, we got the worst possible case scenario, right? We rallied ahead of CPI, so we've already realized most of the upside, and we do not have a lot of upside left, even though I do expect CPI to come in really cool. Cooler than last month for sure. Whether cooler than expectations or not, that remains to be seen because the expectations are pretty low. So it's going to be interesting to see if the market does end up liking this figure or not. If, let's say, we come in at 6.6, 6.7, we'll see if the market likes that or not. My suspicion is that the upside has already been realized, not a lot of upside left, and probably a lot of profit taking on CPI. Let's take a look at market volatility. Continues to form a base asymmetrical triangle with slightly higher lows. That is a bearish signal, guys. So just be careful. So that's it, guys. Tomorrow, 8:30 a.m. Keep your eyes peeled. If we see a gap up, just be careful. I would not be going long on a gap up at this point, simply because we have a lot of resistance at this point. $400 on the S&P. I would be expecting hordes and hordes of bears to come in to really ravage the market at 400. I simply do not see us closing above this resistance line. If we do close, that will be a massive game changer, and it will be closing all of my shorts if that happens. Chances are pretty slim though, so just keep that in mind. So yet again, the market is proving to be evil, and this appears to be the case of buy the rumor of a cool CPI and then sell the news. So be careful, guys. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.